Hello, my name is Catherine Imin. I will be presenting our context and objective and our data sources. This presentation builds on the work we completed in Assignment 1 during our field visit at Bank Islam Currency Exchange in Kuching International Airport. Now, instead of observing the rates, we are taking the real data we collected and turning it into meaningful insights. In this presentation, we focus on two major currency pairs from our dataset and examine how their rates move throughout the week. Our aim is to identify any small patterns or day-to-day changes that occur during the 5-day period. We then compare these movements with international finance theories to see whether the real behavior of the market aligns with the theories predict. Overall, our objective is to connect our real-world observations with the academic concept we learned in class and to better understand how foreign exchange works in practice. Before we move into the analysis, we want to briefly recap where our data came from. All the information used in this presentation is based on our 5-day observation at Bank Islam Currency Exchange. During the visit, we recorded daily buying and selling rates for 5 currencies. Overall, the movements were more stable, but certain currencies showed clearer patterns and slight fluctuations across the week. From these observations, we selected two currencies that displayed interesting trends for deeper analysis later in the presentation. This recap provides the foundation for our exchange rate analysis that follows.
I'm Nur Najwa and I'm going to explain about the currency pair 1 analysis, which is MYR to SGD. So for currency pair 1, we analyze MYR SGD using real exchange rate data collected during our Bank Islam field visit in Assignment 1. So SGD was one of the most frequently exchanged currencies, reflecting strong liquidity. From 24 to 28 November 2025, the selling rate declined slightly from 3.3750 ringgit to 3.3550 ringgit, with stable buy-sell spreads. Despite of the high transaction demand, the movement remained smooth and controlled. This indicates that the change was driven by macroeconomic expectations rather than local demand pressure. And according to the Fisher effect, Singapore's lower inflation suggests long-term SGD appreciation. However, our short-term observation shows a temporary deviation, highlighting the limitation of Fisher effect in explaining short-run movements. And overall, MYR-SGD represents a low volatility and efficient currency pair where firms face gradual trend risk rather than sudden exchange rate shocks.
Good day everyone, my name is Alia and for my part, I will be explaining currency pair 2, which is MYR to JPY using 5-day average data from Bank Islam. From the table, the average buying rate for Japanese yen is 11.808, while the average selling rate is 14.386. This shows a relative wide buy-sell spread, which suggests higher risk and uncertainty in trading the Japanese yen. We also observe noticeable short-term fluctuation, indicating that the Japanese yen is more volatile compared to commonly traded currencies. From an operational perspective, Japanese yen transactions are less frequent than IDR and SGD. The main demand comes from tourists, students, and business travelers. Due to lower transaction volume, the market has low liquidity. Therefore, Bank Islam applies a wider spread to manage foreign exchange risk and protect against sudden price exchange. Next, I will be explaining why this occurs, the theory behind it, and the implication. Japan maintains very low interest rate, and its monetary easing policy weakens the Japanese yen. This leads to higher exchange rate volatility, which increases risk in the FX market. This situation can be explained using the Fisher effect. According to the theory, lower real interest rate cause currency depreciation, and the behavior of Japanese yen in our data clearly support this relationship. As a result, the market priced this risk through wider spread. In terms of implication, business face higher FX costs and uncertainty when dealing with Japanese yen. Banks protect their margin by adjusting spread while the market remains efficient with no perceived arbitrage opportunity. In conclusion, the MYR-JPY exchange rate reflects lower liquidity, higher volatility, and risk based on pricing, which aligns with both market behavior and economic theory. Thank you.
Hi everyone, my name is Brenda Baombelong and my measured number is 103552. Today I'm going to present about theory, comparison and insight. Now, let's connect our finding to the International Fisher Effect, IFE. In theory, IFE suggests the difference in nominal interest rate between country reflect expected inflation. Simply put, countries with a higher inflation usually see their currency value drop or depreciate. So, when we look at our data from Bank Islam, we see a clear match. Currency like the Indonesia Rupiah IDR and Saudi Riyal SAR have a higher inflation rate compared to the Malaysian Ringgit. When we calculate the 1 year forecasted exchange rate, the math confirms that the theory both IDR and SAR are expected to depreciate against the MYR. So our insight here is that the Bank Islam rate aren't random, they are largely consistent with a IFE. This tells us that macroeconomic gaps, especially inflation, are the primary drivers behind the currency trend we observe at the counter. So, next, let's talk about market efficiency and arbitrage theory. During our analysis, we found a theoretical risk-free profit of 51 ringgit 87 cents by looping MYR to JPY, then the SGD and back to MYR on a paper. It look like a free money. However, in a real world setting like a Bank Islam, this profit is mostly illusory. Why? Because of the transaction cost, the buy-sell spread we observe combined with a rapid digital rate updates slow that 51 ringgit profit instantly. The tight spread we saw in high demand pairs like SGD and MYR prove that the market is highly efficient. That Bank Islam, the rate are so well aligned that arbitrage opportunities vanish before a retail trader can even blink. To wrap up this section, our field data prove that while academic theories like IFE provide a great roadmap for a currency trends, the efficiency of the banking system through the spread on technology ensure there is no such thing as a free lunch. Bank Islam successfully balanced global theory with a local market liquidity. To conclude, our visit to Bank Islam provided a clear bridge between textbook theory and market reality. First, we saw that theory works. The International Fisher Effect accurately explained why certain currencies like the Rupiah and Rial are priced for depreciation. Second, we learned that efficiency is a key. While we found a paper profit and triangular arbitrage, the bank's operational speed and buy-sell spread ensure the market remains stable and fair. Ultimately, Bank Islam demonstrates a sophisticated pricing strategy that respects global economic signal while staying competitive for local travelers. That's all from me. Thank you.